picture a photograph of a neon sign.
Okay.
It's just glowing brightly in the dark, and the crisp white letters spell out this really simple command: do something great.
I like it.
Right. And, in the investing world, doing something great has traditionally meant one very specific thing, which is finding alpha.
Beating the market.
Exactly. Beating the market, finding that diamond in the rough before anyone else does. You put in the work, you read the balance sheets, and you win. It's a meritocracy.
That's the classical view, yeah.
But what if the fundamental rules of that game have just completely changed? Well, we weren't looking.
That is the big question.
And that is exactly what we are unpacking today in this deep dive. We're using a remarkably detailed May 2026 paper by an author named Mr. Schmidt. And he synthesizes some pretty heavy paradigm-shifting theories from financial thinkers like Michael Green, Hari Krishnan, and Stephen Sturm.
Yeah, and the core argument there is that passive investing might actually be breaking the market's fundamental mechanics.
Which is terrifying.
Yeah.
But we are also going to look at how an obscure corner of the financial world, specifically quality microcaps, might serve as this sort of structural escape hatch from the incoming storm.
It's a fascinating premise because the core thesis of Schmidt's article, it really forces a total reevaluation of how we talk about markets.
Right.
I mean, for decades, the entire financial industry debated active versus passive performance, right?
Like which strategy yields a higher return net of fees.
Exactly. But Schmidt's synthesis of Green and Krishnan's work suggests that that debate is practically obsolete now.
Because the conversation has shifted entirely to market architecture.
Precisely. We are no longer talking about strategy, we are talking about plumbing.
Market architecture. Okay, let's ground that concept for everyone listening. Because we are essentially talking about how the price of a stock is actually set on a daily basis.
Right, because we're so used to that old Benjamin Graham idea that the market is a weighing machine.
Sure, over time, fundamental value is reflected in the price.
Yeah, but passive index funds operate on a completely different physical law. By definition, they are price insensitive.
Right.
When your automated 401k contribution hits an S&P 500 index fund, that fund does not evaluate the macroeconomic environment.
Doesn't care.
It doesn't care at all. It doesn't check a company's debt-to-equity ratio. It doesn't look at the CEO's track record or, even consider if the stock is wildly overvalued.
It simply buys the stocks in the index based on their existing weight. Money comes in, money gets deployed blindly.
Blindly, exactly.
Okay, let's unpack this.
Yeah.
Because in a normal, healthy market ecosystem, you have active investors. And Mr. Schmidt calls them the guard dogs.
I love that term.
Yeah, it's a great visual. They are the ones actually reading the quarterly reports. So if a stock gets way too expensive relative to its earnings, these guard dogs short it or they sell their position.
And if it gets too cheap, they buy it up.
Right. They provide the friction that pulls the market price back to reality.
And that mechanism is mean reversion. It is literally the immune system of the financial markets.
But Michael Green, Hari Krishnan, and Stephen Sturm, they modeled what actually happens to that immune system as the proportion of passive ownership grows.
They did. And their data points to some very specific, really critical thresholds. As passive ownership increases, the power of those active guard dogs weakens.
Because they're just outgunned.
Completely outgunned by the sheer volume of automated flows. So the model suggests that once passive ownership crosses approximately 65% of the market...
65%.
Yeah, at 65%, the market's ability to correct itself, that mean reversion we talked about, begins to seriously diminish.
So 65% is the threshold where the guard dogs essentially just get overwhelmed by the sheer tonnage of the passive money.
Yes, and the model gets significantly darker from there.
Uh-oh.
Yeah, when passive ownership hits 90%, volatility does not simply increase linearly. It begins to trend at what they call cubic speed.
Okay, wait. I want to pause on cubic speed because that sounds like a sci-fi term.
It does.
How does volatility mathematically accelerate like that in a stock exchange?
Well, think about an order book.
Okay.
Which is just the list of people willing to buy and sell at various prices. Active investors populate that order book at different price levels based on their own valuation models.
Right, they are the liquidity.
Exactly. But when 90% of the market is passive, those active buyers disappear. The passive funds only trade to rebalance or deploy incoming cash. They aren't sitting there setting limit orders to catch falling stocks.
Ah, I see.
So if a negative macroeconomic shock hits and it triggers a sell-off, the stock price doesn't just drop by a few cents to find the next buyer.
Because there's no one there.
Right. There are massive air pockets in the order book, so a tiny sell order can trigger a free fall because you have to drop $5, $10, maybe $20 down the price ladder before you find a single human willing to catch the knife.
Wow. So the descent just accelerates geometrically.
At cubic speed.
So if traditional active investors were the market's immune system, fighting off crazy valuations, passive index funds are essentially like an unstoppable conveyor belt that just keeps dumping money onto the biggest pile.
Yes.
Completely, regardless of what's underneath it.
That's a perfect analogy, and that mechanical trading acts as pure noise. It completely obfuscates the actual value signal of these companies.
Because the conveyor belt moves so fast.
So fast and with such weight that the fundamental signal is just drowned out entirely.
And the sources bring up a really specific phenomenon resulting from this conveyor belt. And it has an incredibly memorable name.
Oh, cocaine on the tables.
Yes, cocaine on the tables.
It perfectly describes the artificial stimulants created by this mechanical flow of money.
Because when passive money flows blindly into a broad index, say the Russell 2000, it buys everything in that basket indiscriminately.
Which ends up propping up what Mr. Schmidt calls zombie companies.
Right. And these are businesses with terrible fundamentals, mountains of debt, failing business models.
Total zombies.
And in a rational fundamental regime, these companies would see their stock price plummet. They'd be starved of capital and go bankrupt, clearing the way for healthier companies.
Creative destruction.
Exactly. But because they happen to be listed on the index, the conveyor belt just keeps handing them fresh cash every 2 weeks when America's paychecks clear.
It really is wild when you think about it.
It's like Weekend at Bernie's, but for corporations.
Yes.
The index fund is just carrying the corpse around and pretending everything is fine.
Because those passive flows mask the deterioration of their balance sheets. The mechanical bid keeps them artificially alive.
Okay, so if the passive conveyor belt is inevitably going to snap or, hit this cubic speed volatility, why wouldn't a rational investor just buy financial insurance?
Wow.
Because usually you just buy long-dated put options, maybe some LICHB, to hedge against that tail risk. If you know a massive structural storm is coming, you buy a policy.
Michael Green addresses this directly by defining what he calls the insurance gap.
The insurance gap.
When institutional investors want to buy insurance against a market crash, they do look to those long-dated put options, a contract that gives them the right to sell their portfolio at a fixed price, even if the market falls to zero.
Right.
The fundamental issue is that the market for structural insurance typically only extends about 2 years out into the future.
And the shift toward passive investing isn't a sudden shock like a pandemic or a surprise interest rate hike.
Exactly. It's a slow-moving, multi-year demographic shift.
So you can't just time it.
What's fascinating here is the mechanism of options pricing, specifically time decay or theta. You pay a premium for a 2-year put option. Every day that passes without a market crash, that contract loses a fraction of its value.
Right. Time is working against you.
And if you reach the 2-year mark and the passive machine hasn't broken yet, your insurance expires worthless. You have to buy a new one.
Which gets expensive.
Doing this rolling hedge for a decade, just waiting for a structural break, will bleed your portfolio's principal dry. The cost of carry is mathematically ruinous.
Plus, and I was thinking about this, who is actually selling you that insurance policy?
The market makers, major banks and financial institutions.
Right.
And this introduces massive counterparty risk. If the system fractures at cubic speed, the entity that sold you the insurance, the bank that owes you the payout, might have its own balance sheet vaporized by the very same crash.
Oh, wow. So you hold a winning lottery ticket, but the lottery commission has burned to the ground.
Exactly. The traditional tools simply do not stretch far enough into the future, nor are they robust enough to protect against a fundamental breakdown of market architecture.
I mean, we're painting a pretty bleak picture of the main stock exchanges here.
It's sobering.
If you can't afford the insurance and the guard dogs are overwhelmed, are we just sitting ducks? Where is the exit door?
Well, Mr. Schmidt proposes a very specific structural refuge.
Right.
If the main risk is the mechanical flow of money into major indices, the solution is to find assets that are mathematically excluded from those flows.
And his thesis points directly to global small caps, microcaps, and niche international equities.
Yes, it does.
I really want to dig into the mechanics of this, specifically something called the float filter, because on the surface, This sounds counterintuitive to everything you are taught in Finance 101.
I know, it does. But major index providers like the S&P or MSCI have really strict rule books for which companies they will include.
Okay.
And one of their primary metrics is free float adjusted market capitalization. They only calculate the value of the shares that are actually available to trade on the open market.
So they explicitly ignore shares locked up by founders or early insiders or strategic partners.
Exactly.
We were getting hung up here. Let's say you have a highly profitable microcap company.
Okay.
The founder owns 70% of the stock, leaving 30% floating on the open market. If Vanguard or BlackRock manages trillions of dollars, why wouldn't their algorithms just scoop up that available 30%? Why is a low float an impenetrable shield?
Because trillions of dollars cannot fit through a tiny door without blowing up the building.
Oh, yeah, makes sense.
If a mega fund tried to allocate even a fraction of a percent of its capital into a microcap with a tiny free float, the sheer buying pressure would drive the stock price up thousands of percent in minutes.
Which breaks the whole system.
Right. Furthermore, index rules explicitly forbid this to protect their own tracking error and comply with regulatory limits. They require a minimum dollar amount of daily trading volume, often in the tens of millions, just to ensure they can get in and out without destroying the price.
I see.
A low-float microcap simply does not generate enough daily liquidity to meet the mandate of a multi-billion-dollar index fund. It is mechanically invisible to them.
Okay, here's where it gets really interesting. So in the traditional investing world, illiquidity is almost always seen as a risk premium. It's a bad thing.
Absolutely.
It means you can't easily sell your shares without taking a haircut on the price. But you are saying that in this specific architectural context, being hard to trade is actually a superpower.
It really is. It acts as a protective shield. By staying small and relatively illiquid, these companies remain in what Schmidt calls a fundamental regime.
Because the passive machine cannot absorb them.
Exactly. Price discovery is still happening the old-fashioned way.
The guard dogs are still in charge there.
Yes. Active participants are forced to actually read the balance sheets, analyze the cash flows, and debate the intrinsic value of the business.
The price is set by cognitive thought, not just automated allocation.
Right. And Schmidt also heavily emphasizes looking at international markets, specifically ex-US.
Why is that?
Well, many international jurisdictions have significantly lower passive penetration compared to the United States.
Oh, okay.
So the active investor is still the primary price setter there, which offers geographical insulation from the U.S.-centric passive break that Michael Green models.
Okay, stepping completely outside the safety of the main stock exchanges sounds great in theory. But let's look at the dark side of this strategy.
Let's do it.
What happens when the big passive machine actually breaks? There is a scenario mentioned in the text that outlines a no-trade regime, and it requires a total shift in how we think about risk.
Yeah, because in the large cap world, the Apple and Microsoft ecosystem, when the market crashes, the primary risk is price risk.
Right.
The value of your portfolio drops 30 or 40%, but the assets remain highly liquid. There is always a buyer at some lower price. You can hit sell and raise cash.
But in the microcap world, the risk is fundamentally different. It's a liquidity gap.
Exactly. If a passive collapse causes massive systemic panic across the broader financial system, the secondary market for microcaps might just stop functioning entirely.
Stop completely.
Yes. The bid-ask spread, the difference between the highest price a buyer is willing to pay and the lowest price a seller will accept, becomes so absurdly wide that trading literally ceases.
So the quote on your computer screen becomes totally meaningless.
Totally meaningless.
You might see a price of $10, but there is literally zero volume. If you hit sell, nothing happens. There's no counterparty.
And that is the no-trade regime. It tests the absolute core of an investor's philosophy. And it leads to Schmidt's most crucial caveat.
Which is?
You cannot just buy a basket of random microcaps to escape the passive machine. The companies must have exceptional quality and they must generate free cash flow.
Okay, so if the stock market is a bank and the bank locks its doors so you can't trade your shares, the company itself needs to be its own ATM.
That captures the mechanics perfectly.
Okay.
If a company is generating real distributable cash flow, it does not rely on the stock market exchange to reward its investors. It bypasses the broken secondary market entirely.
Oh, wow.
It takes its operating profits and deposits cash directly into your brokerage account through dividends, Or it aggressively repurchases its own shares, essentially buying out its partners and increasing your ownership stake.
That's amazing. It's the direct transmission of value from the business operations to the investor, entirely skipping the broken ticker tape.
Precisely. If the market refuses to price the stock fairly or refuses to trade it at all, the company creates its own internal liquidity.
This sounds incredibly compelling, but it is not a magic bullet.
Not at all.
By stepping off index, you are making a very deliberate trade-off. You are intentionally trading away systemic flow risk, the risk that the passive machine breaks, and in exchange, you are absorbing idiosyncratic business risk.
Yeah, because a microcap company does not have a macroeconomic safety net.
Right.
It rarely has diverse multinational revenue streams like a megacap tech conglomerate. If a microcap's primary product fails or its management makes a fatal error, it dies.
It is not considered too big to fail by the government.
Exactly. The rigor of your fundamental analysis has to be flawless. A structural refuge is only a refuge if the building's foundation is actually sound.
And there's another layer of danger here, pulling from Andy Konstan's research in the text, the concept of contagion.
Oh, yes, contagion.
The idea that in a true panic, the structural walls between these markets might not hold up.
Konstan's warning focuses on the mechanics of a systemic liquidity event. The break rarely stays localized. Imagine an active fund manager who runs a portfolio with a mix of large-cap tech stocks and a few highly profitable liquid microcaps.
Okay.
If the large-cap passive machine breaks, it often triggers massive margin calls across the industry. That manager is suddenly forced to raise cash immediately to cover their leveraged large-cap positions.
And because the large cap order books have those air pockets we talked about earlier, you can't sell the broken large caps without taking an 80% loss.
Exactly. So you sell whatever you actually can sell.
You sell your pristine, fundamentally sound microcaps.
Yes. Not because the microcap company did anything wrong or because its earnings dropped, but simply because it is the only asset with a bid attached to it.
You just need the cash to save your core positions.
Right. In a true panic, as Constant describes, correlation goes to 1. All assets move down together regardless of their individual fundamental divergence. The desperate need for cash overrides all valuation models.
And Constant also knows a psychological trap here, right?
Yeah, he points out that the late stages of these bubbles are actually characterized by low volatility and rising prices. It lulls active managers to sleep.
Which actively encourages them to take on more leverage to keep up with the passive indices.
Which just guarantees that when the liquidation starts, the contagion spreads everywhere instantly. The system sows the seeds of its own demise.
Wow.
But there is one final overarching variable we have to consider, which might be the most unpredictable element of all.
The regulatory wildcard.
Yes. We have to look at the massive institutional vested interests here. Vanguard, BlackRock, state pension funds. These entities have built their entire empires on the passive investing model.
More importantly, passive index funds are the default vehicle for global retirement systems. The 401ks in the United States, the superannuation defaults in Australia, statutory pensions in Europe. Millions of everyday people have their life savings tied to this conveyor belt.
And governments and regulatory bodies cannot allow that machine to break without risking unprecedented societal fallout.
So if the flows start to reverse, say, the baby boomer generation enters retirement and begins pulling their money out of these indices, en masse regulators will intervene.
They almost have to.
So what does that intervention actually look like in practice?
Well, it could manifest as lobbying for lock-in mechanisms.
Like freezing accounts.
Basically, yeah. Regulators might change redemption rules, imposing penalties, or outright freezing withdrawals so that everyday investors literally cannot sell their index funds as quickly as they want to.
We saw similar mechanisms proposed in real estate funds during times of stress.
Right. The stated goal would be to stabilize the systemic flows and prevent a run on the market.
So what does this all mean for the structural refuge? If regulators freeze the big indices to save the retirement accounts, what happens to our microcap escape hatch?
It's grim. It could unintentionally starve the small cap ecosystem of capital even further. If global liquidity is locked up in the mega caps by government mandate, the liquidity gap in the microcap world becomes permanent.
Oh, because the capital cannot flow down the market cap spectrum to discover new innovative companies.
Exactly. The fundamental guard dogs are left wandering in a desert.
It seems like every solution just spawns a new set of complex problems.
Usually does.
As we synthesize all these threads, the ultimate takeaway from Mr. Schmidt's analysis is not just a simple stock tip. It isn't just a recommendation to buy small companies.
No, it's a profound philosophical shift in how we approach capital allocation.
It is about making a deliberate, conscious choice to prioritize fundamental signal over flow momentum.
Because for you, the listener, it really requires choosing which specific risks you are willing to underwrite. You can remain inside the passive machine, accepting the risk of cubic volatility, mechanical noise, and sudden regulatory lock-ins.
Or you can step outside into the unindexed microcap world, accepting the risks of severe illiquidity, idiosyncratic business failure, and systemic contagion.
Exactly. Whether you actively manage your own portfolio or you are just trying to understand why the real economy often feels so wildly disconnected from the headlines about the stock market hitting all-time highs, this framework is a crucial mental model.
Because recognizing that the market's plumbing the actual pipes, order books, and algorithms moving the money might be fundamentally altering reality.
You cannot just play the game. You have to understand the architecture of the board you are playing on. Operating without an understanding of market architecture is essentially flying blind in a storm.
Well said. I want to leave you with one final, slightly provocative thought to mull over.
Okay, let's hear it.
We spent this time dissecting how active investors, the guard dogs, are losing their power in the large cap world, and how they might find refuge in the tiny, illiquid microcap space.
Right.
But what happens if they all realize this simultaneously? If the smartest, most highly capitalized active guard dogs flee the large cap indices and crowd into the microcap space looking for real fundamental value, at what point does that wall of active money become so large that it accidentally creates its own mechanical, passive-like distortions in the microcap world?
Wow.
Can we ever truly escape the machine, or do our attempts to flee just end up building new ones?
That is a fascinating question.
Something to think about. Thank you for joining us on this deep dive. Keep questioning the consensus, keep looking for the signal in the noise, and remember that neon sign. Doing something great means understanding the mechanics of the game better than anyone else.